Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone. I hope all of your preparation is going on amazing and you are prepared for the upcoming examination. In this short video, I want to quickly revise all the common adjustments which are tested in consolidation, amalgamation and internal reconstruction. This will give you an additional boost before you write the examination. How to get this document? The link is given in the comment section. And if you like this document, if you like this quick revision, do like this video, do share it with your friend, and of course, don't forget to subscribe to our channel. So without wasting much of our time, coming to consolidation, common adjustments, you get unrealized profit on inventory sale. Now here, a lot of students get confused as to what to do in upstream, downstream and all of that. Just ignore all of those fancy technicalities. Just think who has sold. If holding has sold, reduce from holding profits. If subsidiary has sold, eliminate from subsidiaries profit. Very simple. Unrealized profit on sale of asset within the group. Now here, the company which has sold, from that company's P&L, you will reduce the profit and you will also reverse the depreciation on the differential amount. If there is whatever is the profit, to that extent, you will also reverse the depreciation. Then, whenever we have intercompany receivables and payables, we will offset them. Here a very important thing, if it is discounted with bank, if any bills receivable is discounted with bank, whatever has been discounted with the bank, to that extent you will not eliminate. Then if there is some cash in transit between holding and subsidiary, you will add that to the cash balance and accordingly adjust from the trade receivables and payables. If there are pre-acquisition reserves and P&L of the subsidiary, whatever is given in the question, that is a part of your capital profit and used to calculate goodwill or capital reserve. Whatever is the post-acquisition profit, you will share that between the holding and the minority. If you revalue any asset of the subsidiary at the acquisition date, you will increase the value of that asset and correspondingly you will also increase the capital profits on the date of acquisition. Subsequently, you will also give the depreciation impact. You will have to provide additional depreciation subsequently. If provision for doubtful debts is not followed by the parent but the subsidiary follows it, in that case what you will do? You will reverse the provision for doubtful debt. Reversal of provision of doubtful debt means what? I will increase the profit of the subsidiary. If subsidiary issues bonus from the pre-acquisition reserves, this will not have any impact in the goodwill or capital reserve computation. What you will do? You will reduce the amount from the pre-acquisition profit and add that to the share capital. Reduce capital profits and increase share capital. If bonus is issued from post-acquisition profit, reduce the post-acquisition profit and add it to the share capital. This will change the amount of goodwill or capital reserve. Then if dividend is received out of pre-acquisition profit, please remember, as per accounting standard 13, it has to be reduced from the investment account. Now, a common adjustment here would be that the holding company has credited the dividend to P&L account. What will you do in that case? If the same has been credited to P&L, reduce from the P&L and reduce from the cost of investment. If dividend is paid out of post-acquisition profit, one simple thing what you can do is just ignore it because it will not impact the total consolidated P&L. If you want, you can do the second option, which is slightly more complicated from examination point of view. Then revaluation of property, plant and machine, equipment or machinery, just increase the value and also ensure you charge on the higher value excess depreciation. If losses have been incurred, then what you will do? You will not make the minority interest negative. You will continue to show minority interest as zero. Additional losses will be borne by the holding company. Now coming to amalgamation. Amalgamation, if there is anything which has been revalued on the date of acquisition, let's say land and building has been revalued, then you will record at the revalued amount. If some assets have been obsolete and sold before acquisition, what you will do? You will not take this or you will not transfer this to the purchasing company. You will record whatever is the loss, you will record that and reduce from the P&L of the transferor company. If shares are to be issued to adjust the rights of shareholders in accordance with the intrinsic value, you will compute the intrinsic value and you will split the total purchase consideration in the ratio of intrinsic value. This typically happens when two companies are merged to form a third company. Now this is a standard adjustment. If a particular percentage debenture holders will be allotted 9% to ensure interest income is same, then what you will do? You will take the old face value, multiply with the old rate, divide by the new rate. Then if intercompany owings are there, you will cancel it after passing the purchase entry, not before that. If inventory is to be taken at a higher value, increase the inventory value, increase the net asset on the date of acquisition and use the higher value for calculating goodwill. If some amount has been waived off by the bank, then what you will do in that case? In that case, you will take the amount which is remaining. The amount which has been waived off will not be taken over by the transferee company. If preference shares holders have to be paid at 10% discount by issuing 9% preference share, here a lot of students get confused. They're saying 10% discount by issue of 9% preference shares at what value? Let us say at 90%, or they may say at 110%, something like that. So in what you will do is, whatever is the preference share capital, you will multiply that with the 90% because you are issuing at 10% discount, divided by the new value. Whatever is the new value of the preference share capital, you will divide by that to get the number of preference shares to be issued. For example, if there are 10,000 rupees of preference shares settled at 90%, new preference shares are issued at 105. Divide that by 105. So existing into 90% divided by the agreed rate. Same income, again whatever we did in the case of debentures, same thing would be done. Debentures are to be paid at 8% premium by issuing 12% debentures at 10% discount. Then what you will do? Total value into 108% divided by 90. Equity shares in proportion of profitability of last 2 years. Compute the profitability. In that ratio, you will split the purchase consideration. Goodwill shown in the books of the transferor company. If amalgamation is in the nature of purchase, then you will not consider this or you will not take it over. You will calculate goodwill separately. But if it is in the nature of merger, then you will take it. Contingent to be taken as actual liability, you will take it as a part of actual liability and reduce the net asset. Bonus shares issued by transferor company before amalgamation. Give the effect to the number of shares and then compute the purchase consideration. Preference shares to be allotted shares at 115, 85 paid up and 30 is the premium. Here, only 85 will be shown as the paid up value. Don't do 100 plus 30. This is wrong. You will take 85 plus 30. Dividend declared, you will reduce it from the reserves and show it at dividend payable. Okay. So that is as far as the amalgamation is concerned. For reconstruction, I don't think I need to explain you again and again. If at all you are stuck with some point, just quickly go through these journal entries, 14 adjustments what I have given. That will be more than sufficient. I hope you find this document very, very useful and prepare well, revise well, and please ensure these 3 questions, see, these are 14 into 3, roughly about 40 marks of question or weightage comes from these chapters. So don't leave it in the examination. And one more thing, don't spend more than 35 minutes for one of these questions. All the best, do well, and we'll see you soon at the next level. Thank you.